Hello, everyone, and welcome to another episode of Forcing Markets. I am your host, Alejandro, and I have my co host, Serhii, with me.
Hello, everybody, and today we will discuss really interesting topic: how you can earn on falling markets. Right, Alejandro?
Yeah, so today we're going to be discussing bear markets and how to create protection for the assets you have, but also how to ensure that if you have new opportunities, you're able to enter them even in a bear market. So we're going to be discussing call options, or not only call options, but just option in general, which is stock derivatives. And you can use this to profit during a bear market, which is what we're seeing right now. So, Sergio, do you have any comments about options before we dive in?
Yeah, probably it will be a good idea to explain to the audience what options are, like, and how can we use it. So, what is the gist of the
It
option?
is. That's a fair point. Okay, so I'm gonna share my screen, and I do have a call option strategy, right? So don't get scared for anyone who's looking at this. I'm just gonna like basically break it down into the most simple thing that I can break it. So you have two types of options, and then you can combine and mix and match and do as much as you can with them. But in its plain terms, what this here is saying is that you have a price, and this price line is not attached to time. This price line basically says price is moving, and it's either moving positively when it moves to the right or moving negatively when it moves to the left. That's basically what this says. Your payoff is based on the movement of the price, and this has an expiration, right? Like it will expire within a certain time. So you have to do something with it between now and expiration. What does that mean? That means that if you have a call option, right, and it's a put, if the price drops and you are long on the call option, you are protecting yourself so that if the price drops below this, somebody else will buy it at this price. So we're going to say this is price one. And on the call, they're basically saying we're going to pay you a premium so that if the option goes above a certain price, we will buy them from you at the price that we agreed upon. And because of that, they'll give you extra money, right? So it's relatively straightforward once you get used to it, but it's kind of a hard concept to understand. So I'm just gonna like basically use real numbers. Right now, Google is selling for $346. And you're saying, okay, I'm gonna sell an option at 330, and there is an interest of 127. That means that there's 127 people selling it or interest in this. So what you do is you say, I can sell this for $21.52. So if you own Google and you bought it previously, you can already capture your earnings at $21.52. If you buy it today at $346, you can basically say 330 plus 21 is 351. So you are capturing approximately $6 worth of profits, but that's where you cap it. And then if you are saying, I bought Google at 330 and I want to protect myself, you can say, I am willing to pay $4.85 so that if Google drops below 330, somebody will buy it from me at 330. Okay, that's the gist of it. Did I explain that well enough, or should I do a little bit more explanation?
I think more or less good. So I can try from mathematical point of view for mathematical part of the audience on the same plot.
Okay. So what this basically means is that when you are looking at your options, you can create what's known as a collar, and that's what this is. So you're saying, I'm going to sell a call, which will give me a premium, and I'm going to buy a put, which will cost me money. So when you sell your call at a premium, you are automatically earning money for that. So here you're earning $21.52 for every share that you agreed to sell for at 330. So depending on when you buy your shares, this is what's going to protect you. And every one of this is per share, but you need at least 100 shares. So, those are all extra concepts, which we're not really going to go on today because that's like very heavy. Today, we're just going to talk about what a collar can do for you. Okay. So what happens here is that between the put and the call, that is more or less like the danger zone. So when you build this, you are building this because you're saying, I want to protect myself, but I don't want to pay that much for the protection, and I don't mind capping my profitability. So your protection happens here, and then notice that like there is a range from the put to the call. That's basically your danger zone, right? That's the zone where the profitability is really unknown because you don't really know what's going to happen during that space.
So basically, Alejandro, as far as I
Right.
understand, can you go back to the charts for a second? Yeah, so as far as I understand, we are buying the stock itself, which is like green dotted line. And if the price goes up, we basically like get more money from it. If the price goes down, we lose money. At the same time, we make a short call, which is dotted line for the like orange color, or it's like reddish color. And the same, if the price goes more than KC, which is like strike price for the short call, right? So we are losing money, but if it goes below that, which is like top part of the dotted red line, so we don't lose money. And what is good here is like basically this solid green line, it's like cancels out if the price goes above the KC, right? Point. And the same we have for long put, which is dotted yellow line. So if the price stays upper than KP, which is like we have constant flows, right? So we paid for this insurance, and regardless of the price, if it stays above KP, so we don't put extra, we don't gain anything, and we don't lose anything. But if it goes below KP price, so we are start gaining money, and at the same time we yeah, at the same time, we are losing money on the like our stock. So basically, at this part, it cancels out, and that's where we have this green line,
Yeah.
which is like straight.
And that's where things can get complicated. But remember, these are not perpetual options like what you have in crypto. These are expiration options that expire. So this is like protection on your stocks with an expiration date. Okay, so how does it
Basically,
work?
this is like one snapshot in the time. Yeah, how to read what is your like compound profit is according to if the price jumps into one direction or another.
Exactly. And so how does that help us? Well, when we run the algorithm that we utilize to tell us what portfolios to buy, and we talked about this before, this one is basically saying Google is holding value and it has a sector ranking of being the number one in customer services. Arguably, I'm sure that, we can defend this and there's other people who are going to say, maybe there's something else in communication services that's performing well. But from what we see, communication services, Google is the stock that the algorithm came back with and said, this is the best one to buy. It says that it has a support price of 330. So that's where we would buy the put, and a resistance price of 362. So this is where we would capture profits. And the current price is 346. So when we go and we select what to buy on the puts and calls, we're looking at all of these prices and we're saying, okay, we are going to cap our earnings at $6 on the current price, 346. So why do I say $6? Well, because if we do the math and we look at the current price right now, because that's really what matters, right? So we have $346 currently. We're saying that we don't want to just make 346 by selling. We're going to do 330 plus 2152, 21.52. That gives us 351.52. And if we look at the current price minus 346.12, this gives us $5.40 of profit. So now if we do 540 divided by 346.12 times 100 times 52 weeks, we are basically capturing an 81% return on this, right? If we do this weekly. Now, This means
So
that you have
assuming
to be
that the
very
option they are
active.
expiring by the end of the week, right? So it's like
Yeah,
weekly
because
options.
this is weekly, we have 52 weeks. So 1.5% times 52 weeks. If you capture 1.5% weekly, you are capturing 81% at the end of the year. So this can be extremely profitable if you do it right. But that's what's important, right? Because in reality, you also have to protect yourself. So if you divide this by 2, which is usually about the money that you want to spend on a put, you end up with 40% profitability, right? So this is more likely to be the real scenario that happens. But how do I come up with those numbers? Well, after you sell the call and you capture your earnings for that week, you still want to protect your earnings, right? So see, here's 485 that you can capture on the purchase. We did it earlier. It was like five something. And now you would have to buy the call at 317, right? That is the low end. That means that you are going to pay 206 to say, I am taking a risk between 317 and 330. So you are only risking $1,200 during this week in order to capture the up swing of this and to protect yourself on the downswing. So you're basically saying, I am willing to bet a certain amount of money to participate in the market and capture my earnings ahead of time. So how do you do that? Well, you enter the market today, you sell a call at a price that is comfortable for you where you still make profits, and then you buy a put to protect your money where you feel comfortable. So now you're saying like, okay, but that means that I'm risking 1250. Yeah, true. You are risking 1250. But not really. Why? Because when you're looking at your color option strategy, the price is changing, right? So if we're looking at the options, notice how like if the price drops, right? If the price is dropping, the cost of both items change. The call goes up and the put goes down in price as the price goes down. If the price goes up, the call drops in price and the put goes up in price, right? So now if you buy the put and you own it, like if you already own this put, you can sell it back. It's yours to do what you want with. So that means that as the price changes, you can profit from the put. So there's this thing called the delta. So we're just going to do a list. And the delta basically tells you how much something is changing, like the change percentage, right? So what you see here, all of these numbers actually have a certain reason for existing. And if we're checking puts only, which is what you own, right? You went long on the put. If we're looking at a price of about 317, which puts us about right here, notice how there's a percentage of change as you go up and down in the price of the market. So this is the price of the stock. And this says as the price goes up, the cost or the value of the put goes down. The farther away the price is from the put, the less valuable that the put is. That means that if the stock goes down in price, your put becomes more valuable, right? So here in this color, you could very well sell your put as the price is dropping. And if it stays right above this, you can actually sell it back to the market for a certain revenue. So instead of saying like I'm risking $1,200, you're really only risking maybe $200 in total. So you're saying I want to do market participation to capture 1.5% return, and I'm about to risk about 0.5% on that. That's actually what it translates into. Okay. So if we're looking at real numbers and we're looking at Google, we would say, I want to buy Google today at $345.43. For anyone who is like looking, that's like right here on the right side. This is where the prices are. This is where the price is. Okay. Now, this green box represents the call. And it basically says you are going to sell a call at $330, so about right here, and that will give you $21, so it puts you about right here. So you're basically saying, I'm selling the stock, I'm buying the stock and I'm selling it, and I am instantly making this much from where the line starts all the way to the top of this green line. That's your profit. You're capturing it right there. So you bought today, you already made 1.5% profit. But now because we are at war with Iran and the Strait of Hormuz and the Red Sea and everything else that's happening is making prices of everything extremely volatile, you're saying, I want to protect myself. So now this drops by about $2 and you start protecting yourself here at 317, right? This where this green line starts. So what happens in this red box? This is really where you have decisions to make. One decision is that as the price continues to drop, the put that you already own will become more valuable, right? As price goes down and gets closer to the put, your put becomes more valuable because you own it. You can sell it back to the market at a profit and keep the stock. If the price goes up in price, if the stock goes up in price, this area is no longer danger. And then the put that you had purchased earlier, that cost you like $2, as this goes up in price, you can actually sell it, but you sell it for a lower price. So you do pay a little bit of money, but you don't have to let it expire. You can actually sell it and make some money back. Once the stock reaches your benchmark, which is going to be the strike plus the premium of the call, then you are at the highest price that you're going to be. So if you are like above here, like above somewhere in here, and you do absolutely nothing, you're already capturing the premium of the call minus the cost of the put. And if you sell the put back to the market, you will actually lower that cost. So to make this very, very simple, your only risk area is this space here between 330 to 317. And because you have control over what you do with the put and the call, because remember, you have a call that's going to expire worthless. It's not going to cost you anything. You'll be able to capture the full $2,100, $2,200 minus the cost of what it costs you to hold the stock, plus the money that you make when you sell the put. This red zone gets hedged. So this is how you hedge all of those losses in order for you to participate and protect your money. If you happen to enter here, right, and you sell a call right here, you would actually make more money, because if you sell a call that's deep within the in the money, you can actually capture better gains. But if you're entering today, this is a strategy that you can have in order to protect your earnings. So you buy a put at a low price and you sell a call at a price lower than your current price. And this will allow you to capture profits up to a certain place. And you can do it again the next week and the next week and the next week and the next week. And as long as you have Google in your portfolio, you can sell the call safely. If you don't have it and you want to enter, then you can sell a short put and enter on that, So there's just a lot of ways that you can use derivatives to make money in the market. But this is one of my favorites, which is the color option strategy, and that's what this here represents. And that is it. That's everything that I had for today's lesson. I'm gonna call it today's lesson on color options.
Yeah, the lesson is really interesting and really good and pretty interesting strategy. And I think in the next episodes, we will deep dive into other strategies as well, and probably more into options also, because it's really interesting instrument.
Oh yeah, options are, when especially during a volatile market like what we have right now, where you have some stocks. Like if anybody's looking at SpaceX, and we'll probably do an episode on this, SpaceX has dropped by 40%. It is selling at $120, which is $15 below IPO. So for anyone who would, like, if somebody was practicing this, SpaceX was holding from 150 to 160 for almost 2 weeks, and then it just plummeted down to 120 because they didn't make their last rocket launch. They basically decided bad weather, they're not going to launch, so they're postponing it until this week because they're playing it safe, right? Smart of them, like, losing a rocket is not something you want to do, so they're postponing by a week. But the market punished SpaceX. Like, as soon as that happened, it just plummeted, right? But right now, they're like a 50% short. So the cost of borrowing these shares is astronomical, and people are still borrowing. Like they're basically saying, on paper, we don't think that SpaceX is worth what everyone else is saying, so we are going to continue to sell. Unfortunately, when you have a short squeeze, when earning comes out, if it comes out in a way that goes against what the market is thinking, everyone who's short is going to have to buy back to cover whatever losses they might have. And that's when we're going to see if SpaceX was a good bet, or if we're going to have to, wait for a while until it goes into the S&P 500. The reason why I bring that up is because if you are losing money with SpaceX right now, you can use calls sold at a short, like short calls at the price of entry, so that you can lower your cost of holding. And we'll talk about that later. But you can use options for a lot of things and keep the stock as your main asset, and then use calls to earn money on your holdings. So that's something else that you can do with them.
Okay. And I think this is it for today. So subscribe, share, like, and see you in the next episodes.
Yeah, for sure. See you in the next episode, everyone. Thanks for watching, and we will see you next time.